Neil Shah, thank you very, very much for joining us from the London Stock Exchange. Neil, can you introduce yourself a little bit and tell us a little bit about kind of what your job is at the LSE and kind of what your specialty is there?
Jonathan, thanks very much for having me. My name is Neil and I lead business development for the tech sector at London Stock Exchange. I was a banker for 15 years. I worked on M&A and I also took a number of companies public, both in the UK, but also in the US. And for my sins, I did an IPO in Frankfurt as well.
No, that's fantastic, Neil. I've certainly enjoyed getting to know you guys and getting to learn kind of about the London Stock Exchange and your AIM listing program. Can you tell me a little bit about it? Because London AIM historically hasn't been like a tech stock market or a tech exchange. Can you talk about how kind of that perception used to be and how you guys are changing now?
Absolutely. AIM had its 25th birthday recently and has really come of age. Today, we've got about 180 tech companies in London, and 130 of those are on AIM, which has always been there for companies needing growth capital. Europe was late to the venture capital party, and AIM and other exchanges filled that void. And today, AIM is as useful as it was back in the 80s. A good story is of Sage, the accounting software business, which was founded in 1981 in Newcastle, probably over brown ale, by three founders. 9 years later, they listed the business, raising about $11 million at the time, and sort of a £25 million market cap. And today, that business is a £7.4 billion business, $10 billion. And you can do that today. Since September, we've had four companies join AIM in the tech sector. 3 were IPOs, 1 was a reverse. And these businesses had revenues between, let's say, £9 million and £40 million, growing anywhere between 20 and 40% top line, and have all been able to achieve good multiples and are all trading quite nicely.
Wow, no, that's fantastic, because my previous perception before I started talking to you guys was that if I wanted to take a company to IPO, if I wanted a company from my portfolio to IPO, I had to have at least 100 million, if not $200 million a year in revenue, that I had to be close to profitable before I could even get a stock exchange to talk to me. So you're saying that that's not the case at the London AIM. Like, how much revenue out of the previous 12 months or so of IPOs, like what's kind of the range of revenue for a company or a startup in the tech space that would be looking to IPO? What ranges of revenue would be appropriate to be able to kind of start a conversation with you guys?
Look, we've seen pre-revenue businesses come to market in technology, in healthcare before. It's not out of the realms of possibility. What we like to see, and I think what investors like to see, are companies that have product market fit, have some revenues to show that the product or service that they're supplying works, some visibility in those numbers, because this is what investors tend to focus on, right? It's your ability to deliver on your expectations. And how you manage those expectations will determine how typically the shares perform in the aftermarket. And so while businesses can be early in revenue, what we like to see is maturity in management teams, guys who know how to manage expectations well. And I think that does phenomenally well in the market. So we see pre-revenue companies come to market. We also see unicorns. In October, we had the IPO of THG, one of the largest technology companies to join our market. In fact, that was the largest internet IPO on record in the UK. Now, it might surprise you, there's been close to 200 IPOs in the US. We've had 28 on our market. But I think London punches above its weight. Because if you really dig into the detail, Jonathan, you'll see that the Snowflake raised just shy of $4 billion. Unity, GoodRx, and Unity, GoodRx, and Zoom Info raised between $1 and $1.5 billion. In the UK, we had THG raising $2.4 billion, and Kaspi, which was the largest fintech and e-commerce platform from Kazakhstan, raised about $1 billion. And so this won't be possible unless we had the investors, and they tend to be global investors in London, supporting these businesses, and not only supporting the IPO, but also with follow-on capital raises.
No, that's fantastic. Can you give me kind of a low, medium, high range of like valuations of a company wanting to list or take their company public on the IPM? What's like a low valuation? What's like a mid valuation? What's like a high valuation for companies IPOing? And then is there a Goldilocks, this is just right kind of sweet spot that you guys have for
Yeah.
that?
Valuation is always a tough one, but typically, investors will dig in to really understand this business. And when they look at comps, they're not just looking at domestic comps, because there you might find, take for example, the semiconductor business. There's two other devices companies on the market today. Historically, we've had plenty more, but where we're looking to price, let's say, an AI processing chip company, we'll be looking to companies like NVIDIA to get a handle on what a good valuation looks like. For a company with scale, strong growth, there's no reason why they can't achieve good double-digit revenue multiples in the UK. In fact, I can give you a few examples where UK companies trade at a premium to their US peers. So just digging in a little bit, Jonathan, there's 180 tech companies with a primary listing in London, right? 70 of those are in software, and then we've got about 35 services companies, 30 hardware companies across semi-cap systems, about 30 internet companies, that's ad tech, consumer internet, marketplaces, and about 15 fintech businesses. Now, what London has historically liked is marketplaces. So if you take, you'll be familiar with Zillow. We have Rightmove in the UK, which is a fourth of its size, but trades at a premium to Zillow. The same with Auto Trader, which is about a fifth of Carvana's size, and also trades at a premium to Carvana. Recently, Just Eat Takeaway was a consolidator in the takeaway space, acquiring Grubhub, which I thought would have sewn up this space globally. And that just goes to show that you can achieve good valuations in Europe. That's in marketplaces. We see the same in IT services. So there's a business called Kainos, which raised $70 million at IPO in 2015 with a market cap of about $200 odd million. That's now a $2 billion market cap business. It would comp with Endava in the US. Endava was actually a British company that chose to go to New York, and it's twice the size. And it's interesting to see that Kainos trades at a premium to Endava as well. And the society services marketplaces, the same in gaming. We've got a number of developers, Codemasters, which is being acquired by Take-Two at the moment, but also Frontier Developments, Team 17, and a couple of services companies working in the gaming industry, such as Keyword Studios and Sumo Digital. These guys trade between 6 and 12 times revenue. And if you compare them to EA and Take-Two at 5.5 times revenue, goes to show that you can achieve good valuations despite being subscale by US standards in the UK. And I think that's a takeaway here, that you can be a big fish in a small pond and get benefits from that. And you're not just getting US investors on your register. It's a very global register.
Can you talk a little bit about that? Because one of the things that's been surprising to me is truly how global the London Stock Exchange perspective is. And that's historically been kind of the LSE's, one of the LSE's sweet spot, is that you guys very much have been kind of very globally focused, even way back in the days of the empire, where a lot of the capital that came for kind of the global kind of expansion of some of these UK companies came from the London Stock Exchange. Can you talk a little bit about kind of your global investor base as well as your global startup base on the exchange?
Certainly, Jonathan, like you said, I think it's historic, given where we sit in terms of time zones, but also our mother tongue is the international language of business. We have a very hospitable regulatory and legal system here. And I think that attracts capital as well as talent. The UK has always been a great place to set up businesses, but as we've seen, we can fund these businesses as well. It might surprise you that we've produced more startups than any other country outside the US and China. I think 82 in number. And this is just testament to this. And these companies are backed by global investors, both in the private domain when you look at VCs and growth equity, but also in the public domain. And this spans both stages of venture, but also market caps. When I was a banker at Stifel, I had a client by the name of Zoo Digital that provided subtitling and dubbing to Netflix and Disney Plus and other OTT providers, as well as traditional Hollywood studios. And you won't be surprised to hear that there were a number of US investors on that company's register, despite being about 50 million pounds of market cap. And it really comes down to management teams being willing to go and see investors. Investors ultimately are looking for alpha, and they want to hear stories where they can double, triple their money. And capital will find good companies wherever they are in the world, and especially in London.
No, that's fantastic. Why do you think that your investor base, why you guys have actually attracted a bit more of a global investor base than, let's say, some of the other exchanges in like Asia, which seem to be really kind of like Asia focused and kind of Asia community focused, or Euronext, which is kind of very much kind of a European investor base and kind of focused? Why do you think that the investor community in the UK has been a little bit more international, a little bit more global?
In a nutshell, I think it's down to the types of companies that we have in London. So I think we've got a 738 of almost 2,000 companies listed in London are non-domestic issuers. And with that will come international investors. And historically, there was some arbitrage where UK companies, especially in the tech sector, were trading at a discount to their US peers. That gap has now dissipated. The pitch 5 years ago to UK and European businesses that I used to give was, well, if you want to raise some capital, I'll take you to the States because that's where you're going to get a premium valuation. And hopefully you've seen for the examples I've provided that that's no longer the case.
And so even with the international companies coming to list to London, because one of the things that I've seen in the private markets is that in some of these kind of emerging tech hubs around the globe, some of the startups can be, compared to like their US comparables, some of their startups can be 30 or 40% of the valuation of like a US or even a UK company. But what I'm hearing you say is that once a company actually from around the globe lists on a London stock exchange, that those valuations are now kind of normalized because it's much more of a global market in terms of stocks. Is that accurate?
That's fair. You're going to spend less time explaining LATAM risk, for example, or African risk to a fund manager in London because the chances are they've already got portfolio companies in that region. It's already less foreign. We have a very diverse community of people, and that's reflected in the asset management industry as well, both domestically, but also the international investors that play in London. So I think some of that goes away. Now, will you get a premium valuation on day one? Probably not. I mean, this is all about proving. I suspect many of these stories are going to be showing these stories. And my advice to founders would be, don't optimize valuation on day one. Focus on the long term. And if you're adding value, you're demonstrating that this is a good company, hitting those expectations, beating those expectations, playing the game of beat and raise with an equity analyst, then ultimately there's no reason why you can't achieve a premium valuation in London for your company, despite where it's from in the world.
Oh, brilliant. I know that you've given a couple of great examples of companies that have listed and grown on the LSE. Is there a recent kind of just like, holy crap, this was amazing kind of story from the last 12 to 18 months that you'd be interested in sharing?
Absolutely. Let's start with the Huck Group. This is a business that was backed by VC, had multiple options on where it could list. Today, Jonathan, it probably has about $1.5 billion of revenue, almost 150 million pounds of EBITDA. What they do is they're a platform for direct to consumer retail. The Huck Group has its own brands in beauty and fashion. And what they've been able to do is find support in the public markets. So they raised 2.4 billion pounds in October. This deal was heavily oversubscribed and covered in a matter of hours. And that for me, in a year, an election year, a year of a pandemic, was just like a holy moly moment where I woke up and realized that ultimately investors are looking for yield. And this is a fantastic company. It's great to see them back this company. And I think that really opened the market in London. We had Koof come out just before that, which was at the other end of the spectrum with about £10 million of revenue. And obviously THE was large, but since then we've seen 6 other IPOs in London.
Wow. Wow. No, that's really interesting. How do you think, one of the things I heard, was watching a video with Chamath Palihapitiya, the founder of Social Plus Capital, was one of the early members of the Facebook team. One of the things that he said last week really, really stunned me. He said that there is this, one of the more profound things that the chairman of the Federal Reserve has said for years, and he thinks is going to be really, really important over the next decade or so, is he basically said that the United States was going to be at near 0% interest rates for the next 5 years or so. When institutional investors, when the pension funds, when the banks, when the fund managers, when asset managers hear that, and they say, you know what, I'm not going to be able to get a whole lot of yield if I'm just buying bonds at close to 0% interest rates. How do you think that's going to affect companies raising money on public markets, or selling equity or selling stock on public markets? Do you think that that is going to, would you agree with Chamath when he said that that is really going to deeply affect the growth of the share price of these publicly traded tech companies, because asset managers don't have a whole lot of other place to put money?
I completely agree with Chamath, and actually a lot of what he has to say. I think he's a very smart individual, and absolutely, I think asset managers are looking for yield. The only place to really find that is going to be in equities. If interest rates stay where they are, the danger, of course, is inflation and irrational exuberance, and that may affect equity windows. But I think as long as we're sensible, you don't get carried away. There's no reason why equities shouldn't, in theory, continue to rise. And with that, I think it's a great time to be, for many investors, be getting back into equities. We've certainly seen that since the start of the recovery here, especially on the back of the vaccine news. We continue to see inflows, and long may it continue, because I think that we don't own enough of the tech sector. Today, in the UK, tech probably accounts for 12% of market cap, below the S&P 500's weighting. And I think we've got a long way to go. I'd like to see that be 20, 30%.
No, that's fantastic. Neil, I think this has been fantastic. I really appreciate your time, sir. I really appreciate the work that you're doing at the LSE, and I really hope that we can help you guys grow that tech sector business on the LSE, and looking forward to partnering with you guys in the future.
Thanks so much, Jonathan. It's been a pleasure.